Hi, everyone. This is Jason Bjerk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest, and thankfully, he's one of my friends. He is one of the largest finance and global macro YouTube channels. He is a successful real estate investor, also a retired entrepreneur, the rebel capitalist himself, George Gammon. Thank you for joining me again.
Hey, what's up, buddy? Glad to be back.
So, George, it looks like we're going to have more Fed rate hikes. About 50 basis points are baked in. I was interviewing bond fund manager Michael Leibowitz. He says 50 basis points on the next Fed meeting, and then probably another couple 25 quarter basis point hikes, and then that may be it. What type of damage are the interest rate increases doing to the global economy and asset prices, in your opinion?
Well, first of all, I'd agree with the person you interviewed. What was his name? Michael. And just because I'm looking at the 2-year, which is at the suggestion of Gunlock, and when you look at the 2-year going back, you see that usually the Fed will to a certain degree, it's not precise, but usually the Fed will follow the 2-year. So what that means is going back 2 or 3 months, the 2-year got up to a high watermark of about 4.7. And now as we speak, it's down around, let's just say 4.25. It may actually be a little higher today because we got the PPI prices out, or the data, and it was a little bit higher than expected. But going back to the 2-year, it hits the high water mark at 4.7. So usually what we see in the past is that's about how high the Fed will go to that high water mark set by the 2-year before they pivot and then start to inevitably lower rates going into the next cycle. So if that's true, right now we're sitting at 3.75. Next week, like you said, we'll most likely go to 4.25. And then we will potentially get another 50 basis points from there. Now, I would also point out the fact that back in 2018, when the Fed was raising rates, they actually didn't get to the high watermark set by the 2-year. Back then, I believe that was around 3% roughly. And as most of your listeners probably remember, we only got up to 2.5. And I think that's because the debt in the system was so much higher. And obviously, there's a strong argument that the debt in the system is even higher now when you include the corporate balance sheet, the consumer balance sheet, the sovereign balance sheet, and the balance sheet of state and local governments. So, but let's just assume for a moment that they're able to hike one more time. They will hike one more time next week, but then after that, they'll hike one more time and get up to, let's say, 4.5. So then the question becomes, how and when will we see that filter through the economy? And I think if you listen to kind of the smartest people out there, they say that typically there's about a 6 to 9 month lag on interest rates. So what we're seeing today as an example in the housing market, that is a result of the interest rates from 6 months ago or 9 months ago. So assuming we get up to 4.5, I mean, that takes a 30-year mortgage. I don't know. Let's just say that 30-year gets up to 8% or so. That would mean that we're not going to see that hit the real estate market for another 6 to 9 months, but we're already seeing nominal price declines. So I just went over a chart the other day looking at the West Coast, like California, San Francisco, and home prices there in nominal terms. And when you adjust for inflation, obviously it's going to be more extreme. But even in nominal terms, prices there are down about 10% over the last just 3 or 4 months, or maybe from their high watermark set earlier in 2022. So, a lot of people are kind of sounding the alarm bells as far as the real estate market. And people are saying, oh, that's just fake news. They forget about the GFC and they say, oh, housing prices always go up. And they always argue short supply, short supply, short supply, short supply. Okay. But even with your short supply, we see that prices come down. And I would argue that, yes, it is true that we are at historically low levels of supply based on some metrics, but you can see a destruction in demand that is so significant that it overwhelms the lack of supply, and you still have nominal prices come down. And if you have nominal prices come down in an environment where, let's say, we're running even at 5% CPI, or probably more realistically 10, 15, that's a huge hit to your purchasing power, and real prices are coming down massively, especially if you compound that over, let's say, 3 or 4 years. um, of nominal price declines, but the CPI running even at an average of, let's say, 7%. So, and one more thing I'd point out, Jason, and I'm sure you just saw this, is the BIS report that was rather shocking when they were talking about the derivatives market and how there's an extra 80 trillion with a T of effectively dollar denominated debt that is not on balance sheet. Now, it gets a little murky, and I totally understand the argument why a lot of experts say that this is a nothing burger and that it shouldn't be on the balance sheet, and it's already reflected on the balance sheets on the banks that the entities are borrowing from, and yada, yada, yada. But still, this just shows the degree to which the system is, I think, what would be the right word?
Fragile.
Fragile, I think, is a good word, but also incestuous. And how you've just got counterparties that all just do business with one another, and that creates this contagion risk and this systemic type of risk, where if you have an extreme move in the dollar, let's say, especially up, or if you get an extreme move in interest rates, that, let's say, they go, I don't know, from 0 up to 4.5%, the Fed fund. And you got to keep in mind that the Fed, to a certain degree, is the world's central bank, because if 70% of the transactions are denominated in dollars, and let's say 70% of the outstanding debt globally is denominated in dollars, when they roll that debt over, even if it's just a hedge, even if there's things that act as a counterbalance on the balance sheet, that's still 80 trillion worth of debt that needs to be rolled over, and it's going to be rolled over within the next 12 months at a much, much higher interest rate. So, that's the example I used on a whiteboard video, which isn't precise. I get it. It's not precise, but just to give the average listener, or the average kind of retail investor, an idea of how this may work. Everyone understands how the mortgage market or the subprime lending panned out during the GFC and what caused the problem there. You had all these teaser loans or teaser rates where they take out a mortgage for $1 million to the McDonald's worker. And let's say that was at 2%, then it adjusts up to 5%. They can't pay the mortgage. They default. That goes onto the bank's balance sheet. And then they have to write that off. That blows a hole in their balance sheet. And then you have this big systemic problem because all of this garbage debt exists on the balance sheets of all these entities that are interconnected. And one is providing insurance for the other, and the other is providing insurance for the other. And we saw how that played out. But now what we've got is basically a $80 trillion, and that's probably understating it, an $80 trillion adjustable rate mortgage for the global economy. So where you've got, to a certain degree, and I understand that it may require nuance there, but to a certain degree, you've got significant interest rate risk, and you do have significant FX risk as well, especially when the dollar goes, like we said, from 95 up to 105 or 110, maybe it goes higher. And then when you have rates, Fed funds, going from 0 to, let's call it 4.5%. So it's not just the domestic economy that is susceptible to this effect of interest rates decreasing demand, decreasing economic activity, and therefore causing a recession, if not global depression.
Yeah, I've been saying for months that strong dollar rising too quickly is a global margin call because of all that dollar denominated debt.
Got it.
But this Bank of International Settlements report that came out, it didn't surprise me at all because actually Kyle Bass, hedge fund manager Kyle Bass, was talking about this a couple of years ago. A large chunk of that dollar denominated debt with the forwards and the swaps and the rollovers, Kyle Bass was saying that it's Chinese state-owned enterprise banks that were using this for funding and hiding it for their housing bubble and their credit bubble. He was talking about this over the last 2 or 3 years. So there's been articles that came out. I think the estimates were over 15 trillion of these exotic dollar denominated debts, forwards and swaps that were just being rolled over, constantly rolled over, and could not be paid off. The articles were coming out 2015, 2016, and the estimate was around 15 trillion back then.
Yeah. So keep in mind, assuming that's true, what Kyle is saying, You combine, and he was saying that 2 years ago when interest rates were at zero. So now all of a sudden, I'm talking about Fed funds. We've got Fed funds going to call it 4.5 or 4.75 at the 2 year is an indication. Plus, you've got the dollar. Back then, what was it, Jason? Maybe it was mid 90s back then, wasn't it? When Kyle said that. And now it's at 105 and it was up north of 110.
They had the dollar in a permanent trading range for about 8 years. So from U.S. Treasury management, Federal Reserve Bank management, they had managed to keep the dollar in a somewhat trading range from around 89 on the low end of the dollar index to about 104-ish, 104 point something.
Yeah.
But we may be having a higher trading range going forward. There's things that they can do behind the scenes, covert belts. One of the main ones is the currency swaps, but you also have the permanent repo facilities that they have set up for foreign central banks. Although I don't think I've seen any headlines where a major central bank actually posted their treasuries and collaterals to get a dollar loan, though. I don't think I've seen anything big yet.
Yeah, I haven't heard anything notable with the standing repo facility either. Obviously, with reverse repo, we've seen that used to a significant degree, but that's for different reasons. And then you've seen the swap lines be used more recently with the Swiss National Bank. Now, that was really on my radar about a month ago because we saw that ramping up, but then they paused and they didn't do any. Well, they did the auction, but no one was there bidding on dollars for 3 or 4 weeks in a row. And then last Wednesday, I believe we had one counterparty. But this was kind of the conclusion of the BIS report that the Fed is going to have to get a lot better at allocating these swap lines, these dollar swap lines, in order to avoid a potential crisis. And even the people that I've been going back and forth with on Twitter that are experts that claim that this is just a nothing burger, and I'm kind of maybe not understanding the risk, even they admit the Fed needs to target these swap lines to in a more efficient manner, because right now these FX swaps, we'll use them as an example. If they are off balance sheet, you don't know where the majority of them exist. So to Kyle's point, they could all, let's say 95% of them exist in China. Well, if you set up a swap line with that Swiss National Bank, then that's not going to really move the needle unless those Chinese banks have a correspondent relationship with those banks that have access to the Swiss central bank's balance sheet, right? And therefore those swap line dollars. So this was really their point, that we need to have some more transparency here. And with that lack of transparency, this could be opening the market, making the marketplace more susceptible to downside risk in the future if we do have kind of a shortage of dollars due to the next black swan event. And I believe they used the GFC as an example, and they used COVID, March of 2020 as an example, when these dollar markets were short on liquidity, and the Fed had to step in with these swap lines to prevent that $80 trillion house of cards from collapsing.
Well, I think the Swiss National Bank was talking to the Federal Reserve Bank with the swap lines because of Credit Suisse. I mean, it's been going around for the last couple of weeks about Credit Suisse making all these collateralized loan obligations and securitizing them, chopping them up, similar to mortgage-backed securities, except the collateral for these things, it's corporate credit or corporate debt, except it's worse than junk bonds, worse than collateral. And they were selling it at one point. They're probably not able to sell it now. They're stuck with the game of musical chairs or hot potato is over. And Credit Suisse was stuck with a lot of this toxic garbage or toxic sausage derivatives. But at one point they were selling it as an income product to pension funds. So these CLOs are worse than junk bonds.
Yeah, and I would add to it that with these auctions that we saw with the Swiss National Bank, it could have been Credit Suisse, but it could have been other entities, because I think at the high point, there were 17 counterparties with one of the weekly auctions that the Swiss National Bank has on Wednesday. So it has it every single Wednesday, just FYI. So you can read their report and see how much was bid for as far as the amount of dollars. And then also how many counterparties actually bid for those dollars.
So you did a video about a month ago about pension funds, the UK repo. were the pension funds borrowing additional funds in the UK repo market and then leveraging up their bond trades and doing other trades? And that's why the Bank of England had to go in. That's why there was a $600 billion emergency currency swap loan from the Federal Reserve Bank to the Bank of England to bail out the pension funds, because there was too much leverage on these bond trades that the pension funds had either hired a hedge fund to do some type of risk parity trade, or the pension funds were doing themselves.
Yeah, I mean, that's the conclusion I came to just by trying to use some common sense and connecting the dots. Is you've got a pension fund that's got a 7% liability. So they need to make 7% return on their assets annually just to meet the obligations that they have promised, or the liabilities that they have, which are the assets of future assets for the pensioners. So if you have rates at zero, it's very hard for these pension funds to make that 8% or 7%, excuse me. So what they have to do is they have to go further and further out the risk curve. Or what they can do is they can say, okay, we'll still buy a gilt, a 10-year gilt, but now it's only yielding 2%. So we need to lever up and we need to borrow money to buy more gilts in order to get that average return up to as close to 7% as we can get. So then the problem is if they're not properly hedged, or maybe they're hedged for interest rates going up by, let's say, 100 basis points over 6 months. But I think what they weren't hedged for were interest rates going up by 100 basis points over a week. And that's when they're caught with their pants down, like, whoa. And that's, I think, when the Bank of England gets a call from these pension funds and says, whoa, you do not understand what you are doing here. If you don't bail us out, basically, if you don't buy the gilts, if you don't stabilize the market, then we could go bust. And so then you have to ask, who's the counterparty on the other side of the leverage that the pension funds are using? So, I mean, I don't know if they're going into the repo market, but still there's going to be a counterparty there, right? And I would assume that they're trying to take on debt that isn't collateralized. Maybe not. Maybe that's an assumption that's not true. But the bottom line is, if they're borrowing to buy additional gilts or sovereign debt to increase that overall return, there's going to be a counterparty there. And if they're not hedged properly, they're not going to be able to pay back that counterparty. And then not only do you have the pension fund go bust, but you also potentially blow a hole in the balance sheet of XYZ Bank that was on the other end of the transaction, which very well could have been Credit Suisse, which is why, or maybe why, you saw the dollar swap lines with the Swiss central bank start to get a bid every single Wednesday when you saw these cracks in the system in the UK, whether it was a month or 6 weeks ago.
The reason I brought up repo and that type of trade was during the last rate hiking cycle here in the US, 2018, 2019, the repo madness crisis. We found out that a lot of hedge funds and pension funds, banks, had borrowed from repo and then leveraged up bond trades, but then they were caught on the wrong side of the trade as the Fed was hiking rates. And so their risk parity trade, where they leveraged their bond trade while the Fed was hiking rates, the existing bonds they own were blowing up. And then a lot of these entities could not pay back the loans that they borrowed from repo. So their leveraged trades were getting killed, the risk parity trades, the bond side of their trade. And then also, well, their stocks were, I think stock market was also correcting somewhat a little bit, but not as much as bonds were because the Fed was hiking rates. And then these entities could not pay back the loans that they borrowed from repo. And then the Fed just panicked and added, basically bought a lot of this stuff, and their balance sheet went up by a trillion officially, I think, in like 3 months.
Yeah. And in thinking through the repo transaction, that's a collateralized loan. So it is interesting, isn't it? That see, you never know if the collateral being used is a T-bill, or is it a mortgage-backed security? Or is it a 30-year treasury? Or is it a 10? I mean, you can kind of safely assume that collateral is a T-bill. Therefore, it has very little interest rate risk because the counterparty could always hold it to maturity. But maybe not. I mean, my good buddy Jeff Snyder points out that there really is no repo rate. The repo rate is simply an average of all the potentially hundreds of thousands of transactions that occur in the U.S. domestic repo market daily. And how big is the repo market? You're talking about what, $4 trillion a day going back and forth. So if the repo rate, quote unquote, right now, let's say for today, was 3.77 or something like that, just below reverse repo. Let's assume that's what it is. That doesn't mean that every single entity got 3.77. It all depends on your credit risk, and it all depends on what type of collateral you're posting. So if you got if you're a credit risk, and let's say Deutsche Bank or something like that, and all you have to post for collateral to get that cash you need is a mortgage-backed security, okay, well, then maybe you're getting a 5% rate, where someone else that's got a T-bill, like a 1-month T-bill, might get a 3.5% rate, something like that. So again, the question becomes, in that case where the counterparty that received the cash has problems, one could say, well, Jason, that's not a big deal because the counterparty on the other side has collateral to hedge. But then what happens to the price or the value of that collateral while they're holding on to that, while they're waiting for that entity to pay them back? And, that the price could take a big hit. And what does that do to the balance sheet of the entity that's holding that collateral? And then I'd also argue, how do you determine if that collateral was rehypothecated? And if you do have that, sitting in your hand saying, oh, well, I don't care if they default because I've got this nice little treasury right here. And all of a sudden they default and you find out that treasury was used, 20 times for other repo transactions? Who gets the actual collateral? I mean, I don't know. I don't know how that works. But the bottom line, and I think this is what you're getting at, is the higher the interest rates go, the more counterparty risk we have in a system that is already incredibly fragile.
Yeah, we find out who's swimming naked when the tide goes out. I mean, there's less capital available. We're having a tech bust now here in the United States, Silicon Valley, commercial real estate in Silicon Valley, tech bust, commercial real estate all across the United States is in a big bust. There's not a lot of vacancies. There's very little buyers, but the higher interest rates are causing, there's no easy money for Silicon Valley for them to revenue growth only, no profits, keep selling shares to pension funds or to sucker retail investors and dumping IPOs. So all that, the real estate, all the rate hikes are just causing defaults and lack of capital available. And now you're seeing all these frauds come out like FTX and others.
Yeah, and the tide hasn't gone out. I mean, it's going out, but it's by no means all the way out. And another thing I'd suggest is kind of a little trick for your listeners is pay attention to the yield on the 1-month Treasury relative to reverse repo. Because Jason, you know this well, but just for your viewers and listeners, reverse repo is supposedly the way the Fed sets a floor on interest rates, at least overnight rates. And theoretically, this is how it works, is that why would you buy any asset or therefore lend money at lower than the reverse repo rate when you could just quote unquote park that cash at the Fed and get it completely risk-free? So what we see right now as an example is the 1-month T-bill, and I know it's not an overnight rate, but it's pretty darn close. It's like 40, 50 basis points under current reverse repo, which is about 3.8%. But what we have to understand is that reverse repo starting next week is going to go from 3.8, let's just call it to 4.3. So then let's just assume that that's already baked in to the yield that we're currently seeing on the 1 month. But let's just say that it goes up to whatever, 3.6 or something. Now you've got a 50 or 60 basis point delta on what is supposed to be the Fed's way to control the lowest interest rate given throughout the economy. And then you've got that 1 month that is trading, let's say 50 basis point below. So why is that a big deal? In my view, and this is just through many conversations with Snyder, is this is the market telling you that there's an incredible demand for the best type of collateral, which if you have this collateral, it'll give you the best terms when you go to repo to get that liquidity you need. And also, if we think about rehypothecation, we would assume that these primary dealers would be a lot less willing to rehypothecate if they see an increase in the amount of counterparty risk. And if we see if there's this increase in counterparty risk, then they say, okay, well, we were willing to rehypothecate this one treasury 20 times, but now we're only willing to do it 2 times. So what this does is this effectively reduces the amount of overall collateral that is available. Therefore, what would happen to the price? The price goes up, yield goes down. So and obviously there are a lot of variables that are at play there. There are some entities outside the United States that you could argue don't have access to reverse repo on the Fed's balance sheet, yada, yada, yada. But I think as an overall rule, if you want to kind of just, lick your thumb and try to test the wind, or lick your finger and test the wind as far as where the counterparty risk is and if it's increasing or decreasing, just really pay attention to the delta between reverse repo and the 1 month. And the more you see that delta increase, I think the safer it is to assume that the market, the bond market, the smart money is seeing an increase in counterparty risk.
So we've started to see pension fund bailouts here in the United States. I think there was a $36 billion one by the Biden administration. We're recording this interview on Friday, December 9th, 2022. So there's a $36 billion pension fund bailout. Do you expect there's going to be a lot more of those going forward?
Yes, absolutely. Because as your point, or to your earlier point, Jason, when the tide goes out, then that's when you see who is swimming naked. And there's a lot of entities out there that are scrambling to try to find some swimming trunks. I can tell you that for sure. And if it is true that there's a 6 to 9 month lag on interest rate, or on the interest rates filtering through the economy, then let's just say that we get to spring of 2023 and rates are up at 4.5, 4.7. Okay, we're not going to see that really impact the economy until potentially the end of 2023 going into 2024. So my point there is that that's how much time we still have for the tide to continue to go out. So look at what we see happen with Credit Suisse. And by the way, their credit default swaps are higher. It's what last time I checked. The price, which is basically insurance on Credit Suisse, the price of those is even higher than it was during the GFC. So you see this, you see what's happening with the bond market in the UK. You see what that's doing to the pension funds. You see what this is doing to the inversion of the yield curve as far as predicting a severe recession. You see what it's doing to the housing market. You see what it's doing to the used car market. And let's not forget about that, right? And higher interest rates. And you see what it's doing as far as its impact on the overall consumer in the United States. That these higher interest rates combined with real negative wage growth, because their wages aren't keeping up with the rate of inflation, means that their purchasing power is getting squeezed to an even more, a greater degree, right? So we've got another, let's say, year of this filtering through the system, and we've only begun to see the effects of this through everything that we've discussed with the UK. And then you combine that on top of the crypto crash with the NFTs, with Celsius, with Terra Luna, with FTX, which I don't think is the last we'll hear, with these business models that were just basically created or fabricated out of a thin air based on this philosophy of this little magic black box, as SBF refers to it. And, that's a business model that's as old as time. There's nothing new about what was happening in the crypto space. But again, just what we've seen over the past 6 months and the damage and the destruction to wealth is just a mere preview of what we're going to see throughout the next year.
So do you expect then in 6 to 9 months from now, as interest rates filter through, asset prices maybe fall, we get a crash in real estate? We haven't had a residential real estate crash throughout the United States yet, similar to 2007 or 2008 quite yet. Maybe in certain areas it's starting, but it's not pervasive like in 2007 or 2008. Do you think then that the Fed will be forced then to stop rate hikes, maybe do a 180 and quantitative tightening, which is a fancy name of saying balance sheet reduction, and then go back towards Japanification, yield curve control, because it seems that Japan has finally hit its limits. Throughout financial history, historically at least, Japan got away with it more than anyone else for 30 years. Normally, governments and central banks can only either protect their currency or defend government bonds. They couldn't do both. Japan was able to do both. So do you think then there's going to be a limit? The Fed's going to hit a limit because of U.S. federal government spending then? It seems that there's going to be a math problem, George, 2023 with these higher interest rates. I know you did a presentation on this at one of your conferences, that next year interest payments on the national debt are going to get very ugly with these rate hikes.
Yeah, they are, but that's a tough question, Jason, because I know Groman talks about this all the time and he makes great points, but I realize the demand is shrinking for the long end of the curve. I get it. And there could be some liquidity problems. I think really your only buyer is the foreign private sector right now on net balance, right? But that's the long end. That's when you're talking about a 10-year, 30-year. And the demand dynamics for that security is far different than that 1 month T-bill we were talking about. And right now, if the yield is telling us anything, especially when we look at it through the lens of reverse repo and Fed funds, that there is excess demand for the short term. So if this is hypothetically, if Janet Yellen came out and said, okay, we've got to deficit spend to a greater degree, we've got to do a CARES Act 2.0, the national debt's going to blow out, it's going to go through the roof. I think the market comes out and says, okay, well, who's your buyer right there? Because they're getting hyper focused on the 10-year and they're worried about liquidity at the long end, which they should. But then Janet Yellen comes out and says, okay, but yeah, we're not going to issue any 10 years. We're only going to issue 1 month and 3 month T-bills and then just keep rolling them over. I think that there could be a scenario where that's absorbed by the market and we don't skip a beat because demand is so high for that collateral, ironically, because of the increase in counterparty risk, which, by the way, the U.S. deficit would only add to. So, I think that's something that is not as obvious as it may seem, just analyzing it on the surface, when you just look at the deficits and you look at what the United States will have to spend in the future, even if we don't have a CARES Act 2.0, and then you juxtapose that with just maybe some liquidity issues that we've seen at the long end of the curve.
Eventually, though, the U.S. federal government, because they are the world's largest debtor, though, they're going to inflate the debt away. They're going to want to inflate the debt away. So issuing more and more short-term debt, rolling it over. China's not buying U.S. treasuries. They're not net buyers. Japan's not net buyers. Germany's not net buyers. The normal net buyers for these countries that were wanting large trade surpluses and recycling reserves, that's not happening. A lot of that's because of energy prices, because these countries are having to import so much oil and natural gas at higher prices because they banned drilling in most of their countries. So they're importing liquefied natural gas, importing oil. So I would suspect that the U.S. would want to try to inflate the debt away because that's what governments have historically done. But it sounds to me like you've laid out the case that they can still get away with it for at least another couple of years in the short term of issuing the short-term debt and still inflating a lot of it away or just rolling it over.
I think there is room for them to kick the can down the road further. Now, keep in mind, I want to be very clear. I'm not saying that that's a panacea. I'm not saying that's a solution or a silver bullet. That will definitely make matters worse. And the longer you kick the can down the road, the higher the price that we all have to pay when it is time to pay the fiddler, which at some point we're going to get there, right? But I do think there's a little more room because of that demand that we're seeing at the front end of the yield curve with those T-bills as it pertains to collateral. And that demand will most likely increase, assuming we go into a global recession where the counterparty risks increase potentially exponentially. So I just want to be very clear that that's what I'm referring to. Now, as far as the United States having to inflate away the debt, absolutely 100%. But where that gets really interesting, Jason, and Groman points this out, is people assume if we get, let's say 10, 15% inflation or whatever it is, that the receipts, the tax receipts will go up. And as you know, that's why the Fed, that's why the government needs inflation. It's not just for the sake of inflation. That's not what inflates away the debt. What inflates away the debt is increasing the nominal tax receipts that you're getting, right, relative to your debt. So my point is, if we get significant inflation through quote unquote money printing or however they do it, but if we see tax receipts go down, then it doesn't make their position any.
The Fed has to plug the gap then, or they have to find another buyer of the U.S. Treasuries to subsidize. So either the Fed does QE and plugs a hole there for the budget deficits with the tax receipts. So that's the problem.
Yes. So my point, and you articulated it well, is that we could see significant inflation that's produced by the government or the central planners, but yet their debt to GDP problem doesn't get any better because, as you know, and you've pointed out many times, their tax receipts really aren't correlated too much to inflation. They're more so correlated to asset prices.
Yep.
So if you have a 1970s type of scenario where inflation is running high, but asset prices are going down, I'm specifically referring to 1974 bear market, where the stock, where the S&P went down by 50% in nominal terms. So if you get an environment with high consumer price inflation, but asset deflation, that means the tax receipts are still going to go down. And even in this inflationary environment, the debt to GDP continues to expand.
Yeah, and the consumer then is not, this is why the Alan Greenspan Fed was talking about the wealth effect, which is really the Cantillon effect, to inflate asset prices so they can siphon off more tax revenue with higher stocks, bonds, and real estate in nominal gains. So they inflate the asset prices and then government takes more tax revenues. But if asset prices are down, the economy's in a recession or depression, the consumer's not going out to eat as much, the consumer's not shopping, the consumer's not buying assets. Maybe they're trying to trade stocks, although if it's a bear market, it's going to be harder for them to get any long side trades for a lot of profits there.
Yeah, another risk I would point out too, Jason, is the dollar going down. So I know we've talked a lot about several things that are dollar positive. When I talk about dollar positive, I'm talking about in relationship to other fiat currencies. I'm not talking about relative to goods and services in the United States. Two different topics there. But if we think through the last, call it year, from a standpoint of a Japanese pension fund, or a large pool of money, you looking at the 10-year Treasury, it makes a lot of sense because you don't care that the CPI in the United States is humming along, let's say at 7 or 8%, because your expenses or your liabilities are denominated in Japanese yen. So who cares what the inflation rate is in the United States? The only thing you care about is what the asset side of your balance sheet is doing relative to the liability side. So if you're holding on to these treasuries, and let's just say that you're getting 4%, and let's just say that the dollar has appreciated 20% against the yen, which your liabilities are denominated in, this is an absolute home run for you. So if you are that pension fund and you have a view that the dollar is going to continue to go up, then I think that's going to create a longer term bid for even the long end of the curve, even regardless of the deficits in the United States. The problem there is when that turns. So we're talking about the Fed pivoting. And if they, let's just assume they pivot in April. Let's just throw that out there. And let's just assume when they pivot, then the ECB, for whatever reason, or the Bank of Japan is going to continue to increase their rates. Well, now all of a sudden you've got this opposite interest rate differential, which would be very dollar negative against other currencies. So then if you're this Japanese pension fund and you're holding on to all these treasuries and you were pretty much the only bid in the marketplace, the long end of the curve, now you're looking at it and saying, well, whoa, wait a minute here. I wanted these dollars on my balance sheet because I thought they were going to appreciate in value relative to my local currency. But now I think they're going to depreciate. And so I don't want that FX risk. So I'm going to go ahead and sell my dollar assets, i.e. treasuries, and then I'm going to buy something that's denominated in yen that will allow me to match up those assets and liabilities so I'm not caught with my pants down. And so you go from the foreign buyers, the central banks have already hit the exit button for obvious reasons, based on the sanctions with Russia. And if you're a central bank, who on earth wants to hold something denominated in dollars with that counterparty risk? So my point is now, and it makes sense that you have these private foreigners that are creating demand for the long end. But if the dollar starts to go down and you have a change in psychology to where the market assumes the dollar is going to continue to go down because of an interest rate differential or the Fed pivoting, then that trade could not only be unwound, but to a significant degree, where then you would have serious problems as far as liquidity, at least at the long end of the curve, which would be exacerbated by these deficits that you're referring to.
Well, I think that the central banks and governments, their finance ministries, are not just selling treasuries because of the interest rate differential that you said, or pension funds. Well, pension funds wouldn't do this trade, but it would be at the government and central bank level. I think they need the cash, they need the dollars. So they've sold their treasuries like China and Japan have, because they need to import things, key things.
That's a good point.
So their population doesn't have riots. So they need to go buy liquefied natural gas. They need to make larger orders for that. They need to go buy oil because they're not allowing domestic oil and natural gas drilling of their own supply. Or they need, like China, which is always short on food because they have crop problems. So there's been a lot of fertilizer export bans, or the price of natural gas in other countries, like in the European Union, United Kingdom, the price of natural gas is so high, it's just not economic to make fertilizer in those countries anymore.
So this is super interesting, Jason, because if you think this through, you could envision a scenario where we go into a global recession, and therefore, the amount of dollars that are circulating through these companies are going to these countries in order to buy things like commodities that are still settled in dollars decreases significantly. Therefore, the only way that they can get dollars is to, or one of the best ways, I guess, if you exclude money printing, of getting the dollars is to sell any dollar-denominated assets on your balance sheet, i.e. treasuries. So the more the global recession goes into crisis mode, the less dollar cash flow you have, the more it'll prompt these entities to sell their treasuries in order to get the dollars they need to service not only their dollar-denominated debt, but also just to buy the basics to make sure that they can import these commodities, such as energy, into their country. Great example would be Turkey, or another great example would be Japan, something like that. So I think what I'm saying is you could have this at the long end of the curve, you could have this massive liquidity problem where the only buyer is basically the Fed. Like that's it. While at the same time, you could have the opposite at the front end of the curve, because everyone is trying to shore up their balance sheet. Now all these financial institutions, hedge funds in the Eurodollar market. And the best way to do that is with the best collateral to get the best rate from a counterparty. And the way you're going to get the best rate is through holding or offering a T-bill, which is at the short end of the curve. So you see what I'm saying? You could have a very interesting dynamic where there's massive demand and even more and more and more demand as we go further into a recession at the front end of the curve, but less and less demand, creating a crisis at the long end. And I think that is where the Treasury steps in and potentially does this debt buyback, if you want to go down that path. And I'm sure you know what I'm talking about with Yellen saying that, oh, well, we'll just buy the long end and then we'll just issue debt at the short end. And that will, temporarily put a hole in this sinking ship.
I've been interviewing a lot of experts the last couple of months, asking them who would potentially buy those U.S. treasuries at the long end, because I see the U.S. government wanting to inflate it away. I don't see China and Japan be willing to hold long-term U.S. government debt on the long end anymore, and they're net sellers anyway. And the answer that they've been telling me is that they expect rules changes. So the large banks, historically, Lynn Alden has talked about this, that the large banks here in the United States, the rules will be changed and they will be expected to go from maybe 10% US Treasuries on their balance sheet to 30 or 40%. And then, or they go where they force people in their retirement accounts, say 401ks, that you have to hold the minimum amount of treasuries. And then at first, a lot of people are going to say, oh, it's only 1 or 2% required that you buy US treasuries of your total holdings. But that's like getting the camel's nose under the tent. And then they could always change that percentage amount later.
Right. So that's a great point. The question then becomes how much liquidity in the form of savings does the domestic market have in the United States? Meaning, how much purchasing power does the average Joe and Jane have on their balance sheet to actually buy these treasuries, even if they were forced at gunpoint? And is it enough? Is it enough?
Well, no, if the U.S. government's going to keep increasing spending, but there's enough to at least buy time, because there's no long-term solutions for the U.S. federal government. Neither political party has any viable solution to cut spending. Both political parties want to increase spending. The majority of both parties.
Absolutely. And I think that could be part of a two-pronged approach. But I do think it would be wise for people to think through this debt buyback that Janet Yellen has been talking about, where she comes in and buys long-term treasuries, or the long end of the curve, where to your point, we may see some significant liquidity issues, and sells short-term T-bills to finance those purchases where we still see significant demand and liquidity.
Wouldn't that create even more distortions on the yield curve, though? So it's basically a shell game to buy time. It sounds even more ridiculous than what the Bank of Japan has been doing with their yield curve control for a couple decades now.
Yeah, and that's why I want to be clear. I'm just thinking through all of their options. What I am not saying is these options are a good solution, or that they will make things better. No. They will make things worse. I can absolutely promise you. But it could buy them some time.
Well, if you want to talk about actual solutions, the government should focus on being more efficient, like a private sector company, and cut spending, focus on that. I mean, cut government agencies, fire government employees, but they don't have to do that. In fact, the incentives are so perverse here in the DC Metro. Actually, if you're a federal government agency and you don't spend all your budget, so if you don't max out your entire budget, you're penalized. Exactly. So you're risking getting fired. So if you don't spend every last dollar, I mean, I think there was a scandal 5 or 6 years ago. NASA wanted to hand billions of dollars back, and then they started talking about firing people at NASA because the people at NASA said, we don't want to spend billions of dollars.
Yeah. And another thing I want to point out is I was having a conversation with Jim Grant at the New Orleans Investment Conference, which obviously I really cherish. And he was saying there really isn't a liquidity problem. There's just a problem with the market being able to, I guess more so, there's not a liquidity problem. There's only a problem with the price signal, or there's only a problem that we don't have market interest rates. And so what he was saying is that, okay, let's look at the long end of the yield curve. Even if the government starts to spend all this money, deficit spend, and Janet Yellen doesn't come in, and the government doesn't force you to buy bonds, et cetera, there's still not a liquidity issue if we allow prices to do what they do. And that is to solve the problem. So what happens is there's a liquidity issue, sure, if the interest rate's 4%, but go ahead and let the interest rate go up to 20%. And you're going to see that liquidity issue solved very, very quickly. So my point is that market prices solve all of these problems. Now, it will create short-term pain. Absolutely 100%. Because you got to get rid of that malinvestment and the misallocation of resources. But at the end of the day, we don't need central planners micromanaging the price of money or the price of bonds or whatever it is just to provide liquidity. The only mechanism that we need to micromanage the liquidity is prices themselves. And when you have true price discovery and you allow this to work in a free market, you're not going to have these liquidity issues.
Yeah, I totally agree. Free markets, capitalism, the interest rates would have been higher a long time ago. The market would have made interest rates higher. Instead, 15 years, the zero interest rate policy caused all these distortions, caused the another tech bubble, another real estate bubble. They reinflated old bubbles, caused new ones. There was a shale oil bubble from 2008 to 2016-ish, give or take. So there was all those bankruptcies. And a lot of that oil production growth was unprofitable. A lot of it was because of there was zero interest rate policy, and people could not get 4 or 5% treasuries that they could have to retire. So they were desperate, going further out the risk curve and gambling on stocks, or their pension fund. They were funding a revenue only shale oil company or some of these meme stocks.
Yeah, it's just the distortions that we see created by the central planners, that they never have to pay the price for being wrong. Unfortunately, the people that pay the price.
Well, look at Yellen's track record. Look how rich she is, right? I mean, her and her husband together are worth tens of millions of dollars. And if you look at her public predictions, George, the last 15 or 20 years, she's been wrong on everything.
Yeah, exactly. Exactly.
And she fails forward. It's the Peter principle. The more mistakes she makes, but she knows all the right people, and then she's charging hedge funds $250,000 for her to speak at a dinner. All this ridiculous stuff.
Absolutely spot on. Absolutely spot on. And it's incredible that the people that fail the most seem to have the most amount of clout when it comes to the financial media. And they seem to get the respect regardless of how many times they get it wrong. And it's almost an inverse correlation, isn't it, Jason?
Well, look how the mainstream financial media and the mainstream media are treating SBF. I mean, this guy should be in handcuffs. Look at all the counts of fraud. But because he donated to the right charities and his parents are Stanford University law professors and they work with the right political groups, that they're getting all the soft kid gloves treatment.
Yeah, another thing that I think plays into that is this group that he was a part of called, what was it? Effective Altruism. And this is like a worldwide kind of network of these people that basically buy into SBF's worldview. And even the gal that interviewed him on Vox, the reason I think he was willing to do that is because she was a fellow effective altruist. And I think that you've got so many of these people that are sympathetic to that worldview, not only in politics, but in the mainstream media. This, along with all the political donations, could be why he is getting a big pass,
Or his aunt and his other family members are involved with the World Economic Forum and other stuff. Yeah, Dr. Klaus and his political clout endorsing the Chinese Communist Party model, saying how great it is and how the West should adopt it.
Yeah, and I mean, for your viewers and listeners who maybe scratch their head and wonder why Warren Buffett, as an example, for a long, long, long time has been very outspoken on his views and on his political views, and very comfortably says that he favors the Democratic Party. And remember when he even let Obama use the term the Buffett tax? Remember that? And you kind of scratch your head and it's like, why the hell would Warren Buffett agree to do that? Like, what does he care? Why would he be so forthright with his views and claiming, that he is sympathetic to the blue team? What benefit does he get? Well, now we see the benefit. If I tell you what, Jason, not that I would do this, but you can see the rationale for someone who's a billionaire that knows at some point in time in the future they're going to have a target on their back, to currently, regardless of your views, to just say that you agree with the Democratic Party. and give as much money as you possibly can to Nancy Pelosi and AOC and Bernie Sanders and all these people, because you know that if there's going to be one party that's most likely going to come after you, regardless of whether or not you've done something wrong, it's going to be the Democrats. So while you're still in good favor, you might as well butter them up, regardless of what your real views are. And I think that's maybe what Warren Buffett has done for the last 25 years. And maybe that's the same game plan that SBF used and is now paying dividends.
Warren Buffett's dad was actually the Ron Paul of his generation. He was a libertarian. So if you go and look up all the writings and speeches that Warren Buffett's dad gave, he was definitely the Ron Paul before Ron Paul, decades before. So he was a libertarian, talk about gold standard, problems with government spending, the problems that I think Warren Buffett's dad predicted the 1970s stagflation back in the 50s, post-World War II.
Yeah, that makes a lot of sense. I mean, I guess my argument is if Warren Buffett was worth $50 million, he most likely would be an explicit libertarian. But the fact that he's worth 50 billion or more, 100 billion probably, is why he kind of keeps those views hidden. And what he projects to the world through the mainstream media is this view where he's very sympathetic to the Democratic Party and Obama, et cetera.
Well, with his investment dollars, though, Warren's been buying oil and natural gas stocks, because a lot of these oil and natural gas companies, they've had good free cash flow. A lot of them paid off a lot of debt on their balance sheet, even though oil and natural gas prices are down substantially in the last couple months. A lot of these companies are still fairly low-cost producers, and they're still pretty cheap on valuation metrics.
Yeah, and I don't blame him. I mean, he's a value investor, and I think long-term, there's going to be value there. Personally, I'm not buying right now, but I'm definitely have those companies or those resources, those commodities on a watch list. And I'm just waiting for the 2023 recession that the bond market is predicting to go in and get some good deals and just hang on to them for the long term. And, that's where I would defer to your expertise. I mean, companies in the gold mining space, maybe some of these royalty companies, the oil producers. I like, as you know, I like coal, I like lead, I like some of these things that no one ever likes to talk about, uranium, and the prices have run quite substantially. Copper's another one too, man. If you could get copper around 250 or so, my goodness gracious, I personally would back up the Brinks truck on that. And I think that maybe, just maybe, we could see some of those opportunities in 2023 if these massive inversions in the yield curve and the year dollar futures curve really turn out to be correct.
Yeah, so there's actually some really interesting predictions from the Bank of America investment analysts for what assets are going to perform really well in 2023. And they are the short-term use treasuries, like you said, but they're actually picking gold and copper to be the two top performers above that. So I was kind of surprised on the copper pick, maybe because so many hedge fund managers and global macro people are short the copper price and they're projecting a short squeeze. Although I would personally, my educated guess would be like silver, platinum, or palladium would outperform copper. But it looks like gold's price action the last 2 to 4 weeks, George. Do you think it's starting the gold price in US dollars? Because the gold price in other currencies is doing really, really well. It's at or near all-time highs, just not the US dollar gold price. Do you think that gold is starting to look again like a safe haven for the first time in years, the last month or so?
Yes. Well, I don't know, Jason. I don't know if the rise in price is because people are once again recognizing that over the long term it is a safe haven, or if you've just got capital flows going into it as a bet on the Fed pivot and therefore the dollar going down, and they're just using it as a tool to basically short the dollar.
Well,
I don't know. I don't know.
For financial history, I got asked a tough question like this on a Twitter Spaces a couple weeks ago. So someone was telling me the only reason after the October 1929 crash, the only reason gold did well was because people lost faith in government. That's actually not the case. The private sector during a deflation and the depression after October 1929, there were so many bankruptcies that gold was viewed as a risk-free counterparty asset, because once you had the metal and you were storing it yourself, the counterparty risk was limited very, very low compared to owning a stock, bond, investment in an actual company where recession, depression, deflation meant bankruptcy. So higher interest rates, bankruptcy. So I think private sector bankruptcies with these rate hikes, I think you're seeing asset prices falling, which is worrying people. You're seeing more bankruptcies. So I think that is starting to restore some of the safe haven status for gold if we do see a lot more bankruptcies and asset price and falling asset prices.
Yes. But what's interesting there is it's to a certain degree. And what I mean is one of gold's greatest assets is also its greatest liability. And in just terms of price. And you just hit the nail on the head, is that it's liquid. And this is what everyone wants to buy in a crisis situation. But that also means that that's what everyone has to sell in a crisis situation. And so,
well, is China selling their gold though? I would say China's probably sold their U.S. treasuries. Japan sold their U.S. treasuries. So maybe
no,
like
here's what I'm saying.
Yeah,
here's what I'm saying is if you get a soft landing, I see that being just not the gold price goes straight up, but that's going to give a huge tailwind to gold because I think the Fed starts pivoting. Think you see the dollar ease off a little bit. Maybe it's just temporary, and then gold kind of rips higher. But if you get a hard landing, if you get a black swan event, if you get a March of 2020 or a Lehman Brothers, that gold's going to sell off because now it might be very temporary, and that's going to be your buying opportunity if this happens. Because all of these huge pools of money that have gold on their balance sheet, they have to come up with liquidity. And there's nothing that they can sell where the market is giving them a bid. So they've got to sell this gold. And that's why you see in these crisis situations that the price of gold just sells off very, very quickly. But then what you'll see is historically it rebounds very quickly based on the Fed coming in and plugging the hole with something that is fundamentally a tailwind to the price of gold long term. And so I think that's what investors have to kind of tap dance or maybe kind of wrestle with right now. Are we going to have this soft landing, or are we going to have a black swan event where gold could take a short-term hit due to the fact that it is the asset that is very, very liquid?
Yeah, that happened. The scenario where the gold price fell and gold stocks fell actually happened in 2008, 2009. But then you had a big spike from 2009 to 2011 where the gold price went from, I think it dropped down to 800 briefly. So it was over 1,000 and dropped down, I think, below 800 briefly in 2008. And then it rebounded by mid 2011 or September 2011 up to 1900. So that would be a similar scenario to that. But then it comes to the question of why are you buying physical gold or silver or gold stocks then? Are you buying it to try to get rich, or are you buying metal as an insurance policy, a hedge, a portfolio insurance? So it depends why you're buying metal and why you're buying gold stocks then.
Well, this is a great point. And so let me be clear. For my own personal portfolio, I differentiate between gold and gold miners. So for me, gold is simply insurance. So I don't even worry about the price. It's just when I have an extra, let's say an extra $100,000, I'm going to take 10% of that and I'm going to allocate it to gold, just dollar cost average, if you will. But with the speculative side of my portfolio, which is where I would put gold miners, then I try to take a little bit more of a tactical type of approach. And that's all I'm talking about.
It makes more sense. I mean, the gold stocks are where people are probably going to generate their alpha.
Yep.
And same thing with the natural resource stocks. If you figure out which commodities, I mean, at a certain point, and I emailed Jim Rogers about this, asking him, because I know he studies financial history so much. I asked Jim, how long can historically do a lot of these commodity producers and miners, how long can they run at losses? Because I'm starting to see with the earnings reports, just the cost for a lot of these miners are still going up. I mean, labor costs in these emerging markets, if the dollar is strong, what a lot of people don't understand is that the emerging market currencies are weak, and that means a lot more inflation in these other countries.
Right. So their input costs are skyrocketing, and therefore their margins are getting squeezed, assuming the gold price is flat. I don't know, man. I would defer to you and Jim Rogers. You guys know.
Well, you're
You
in
know the
you're
minutia
an
about that
emerging
better than I
market.
do.
You're an emerging market. You're in Colombia, right? So aren't there protests over inflation and they want wage increases? So even if there's a recession or depression globally, I mean, people still see inflation in their daily bills and want wage increases to try to offset that at least somewhat.
Yeah, I mean, if what you're talking about is social unrest and civil unrest due to the fact that we've got negative real wage growth, not just in the United States, but right here in Colombia and probably in most places around the world, I think those chickens are definitely going to come home to roost. I mean, look at what's happening right now in the UK. You not only have purchasing power being squeezed, but then you have energy bills so high that there's just literally millions of citizens in the UK that cannot afford to turn on their heat, for heaven's sakes. It's like we're living in the 1700s almost. I mean, I saw on Twitter today as anecdotal evidence someone that took a snapshot of their thermostat. I don't know if you saw this, and their room temperature, Jason, was 5 degrees Celsius. 5 degrees. That's in Fahrenheit terms. What is that? That's like maybe 45 degrees, something like that. That's the room temperature. Why? Because the guy can't afford to pay his darn heating bill, so he can't turn it on. I mean, this is what we're dealing with right now. And if you want to talk about the fastest path to social and civil unrest, that is when people cannot afford to put a roof over their head, or they can't afford to feed their family. Or another thing I would throw in there is they can't afford to heat the house for their family or to keep their kids comfortable. I mean, that's
Yeah, I'm seeing people blame capitalism and price gouging for that. A lot of that is because of bad ESG policies by these politicians, bureaucrats, and regulators over 10, 15, 20 years. Because they're
and it's the
not.
sanctions against Russia. I mean, come on, let's just call a spade a spade.
That's still
If
bad government policy. Yeah.
Yeah, let's reverse here.
Aren't the Nord Stream 1 and 2 pipelines that would take natural gas to Germany? Those were blown up. So, so even if they wanted to bring the pipeline, even if they wanted to pipe the gas in, they couldn't.
Yeah, and who blew those up? I mean, we won't go down that path.
Well, they blame Putin, but
right. Who's to blame and who actually did it are probably
Putin.
Two completely separate things.
Well, they always blame Putin.
But I mean, as a thought experiment, I would try to go back before the invasion and just think through what would energy prices be globally right now if we never would have issued those sanctions, if we never would have disrupted the global supply chains, if nothing would have happened. And you can say, oh, George, well, we had to do something. No, we don't have to do something, assuming that is going to hurt us more than it hurts our enemy. That's just a simple cost benefit analysis. And, as a quick, I mean, I know it's not really funny, but as a quick little tweet, I took a picture of the article saying that millions of people in the UK cannot afford their heating bill. And the caption I gave it was "Take that, Putin." And that's basically summarizes what we're dealing with here. We're trying to, get into a fight with Putin while we're punching ourselves in the face. And if you would not have had these crazy sanctions, the UK would be in a much, much, much stronger position, and Europe as a whole, and the United States, to actually do something against Putin that would be effective.
I didn't really want to go to geopolitical stuff. I mean, the government policies are just bad across the board, especially for energy. So we've just reached the point. I mean, they blame Putin for a lot of this stuff, but this has been culminating for 10, 15, 20 years because there's been oil and natural gas drilling bans throughout the European landmass. I mean, there was only a lot of oil and natural gas drilling in the North Sea, and that production is collapsing. I was just looking at a chart for the North Sea oil production for the UK part, and it's just collapsing on its own anyway.
Yeah, and banning nuclear and all this stuff. It's definitely, there are a lot of variables that went into the current crisis we're seeing. That's for sure. But to your earlier point, it all stems back to one entity, and that's the government.
Oh yeah, government policies have caused all these problems. They printed too much money. It wasn't just the US, it was all these governments and central banks, many trillions of dollars, and then they shut down the economy and caused supply chain problems. So it was obvious there was going to be stagflation and distortions because they were shutting down businesses, shutting down supply chains, and people had all this extra currency to go buy stuff. And then there wasn't as many goods available.
Yeah, yeah. And now what they're doing is they're trying to put a price cap on energy as if price controls have ever made things better in financial history. I mean, you go back and just show me the time when price controls actually were a positive on net balance. I mean, it's ludicrous.
So it will probably keep politicians and bureaucrats in office for another election cycle or two, and that's all they care about.
Exactly.
Especially if they can funnel more ESG contracts to their friends and family members in those companies in the short amount of time, they can make some extra cash. They can get Hunter Biden rich.
and they know damn well what they're doing, Jason. It's not like they're completely ignorant to the fact that their policies are destroying the poor and middle class. Like I always say on my videos, they're either stupid or they're evil or they're both.
Well, doesn't Dr. Klaus want us to eat bugs?
Yeah, and I think that now it's safe to assume that they're both. They're stupid and they're evil because they know darn well what their policies are going to do, and they do them anyway. And it's sick. It's morally reprehensible.
Well, unfortunately, things are heading the wrong direction with central bank digital currencies and bad policies. But almost all the problems have stemmed from bad policy from government and central banks. People are like, oh, we can vote in different politicians. Oh, we can implement change. As soon as change politicians come here to DC, I mean, they're sabotaged or they're offered bribes or blackmail.
Yeah.
Well, George, I really enjoyed our discussion. I kept you for over an hour, and I thank you so much for your time. If my listeners want to take a look at the Rebel Capitalists, either your main YouTube channel or your Rebel Capitalists, how do they do so?
They can just go to YouTube and type in my name, George Gammon. And my main channel will come up with the whiteboard videos. And then my other Rebel Capitalist channel will come up as well, where I just do 2 or 3 live streams a day, just talking about the news as it pertains to freedom, liberty, and free market capitalism.
And keep up the great work. How is that lawsuit going with the Federal Reserve Bank?
I mean, not as well as I'd hoped. But we did all the whole FOIA request thing, and now Barnes has to actually file a suit, and hopefully, we make some progress here. I mean, we're going to keep pushing. That's the bottom line. We're going to keep pushing and pushing and pushing until we make some progress. And I was just actually going back and forth with Barnes last week, and I think he's getting together some of the documents that we've actually received from the Fed to kind of make those public, a little bit like the Twitter files. And so people can see what we're dealing with the shenanigans that the Fed is trying to pull to do everything in their power to make sure that we can't access the files that we're requesting and that we have a right to, based on the FOIA.
I mean, a lot of these different government agencies, George, I don't know if you've ever seen some of the documents that they release with a FOIA. Sometimes it's sharpied on both sides, so you can't read it either. So they're like, oh, we complied, but all the documents are literally just black sharpied out on both sides of the document, so you can't even turn the page over and kind of see some of the writing, and they intentionally sharpie over everything except for a couple words.
That's pretty much exactly the type of nonsense that we're dealing with. I mean, you're just dealing with like 3rd graders and the tactics that you'd expect out of a child.
Well, it's even worse with the Federal Reserve Bank, with all the secrets the Federal Reserve Bank has with the bailouts. I mean, Danielle DiMartino Booth has talked about this in the past. They have top secret security clearance levels, and she wasn't even privy to a lot of the information about the bailouts in 2008, 2009, because she said her top secret security clearance level wasn't high enough.
Yeah. And that's we've asked for a lot of documents. In fact, Barnes, I think, asked for documents even going back to the origination of the Fed. But my main push with this was to get documents based on what they did in 2020 of March, and then try to reconcile that with the Federal Reserve Act, just to point out to the general public how they completely violated the law that is meant to constrain them. That was really the thrust of my what motivated me to, so far put whatever $65,000 of my own money into this, and that's what still is the main driver of why we're doing our very best to make sure that we see this through, even though the Fed is trying to put as many roadblocks in front of us as they possibly can.
Yeah, the team of lawyers at the Fed is really crafty. They're cunning old foxes. I've actually seen some of their old lawsuits because the Gold Antitrust Action Committee, those are the GATA people for gold price manipulation. They've sued the Fed a bunch of times over the years, and then they posted the Fed lawyers' responses. And I've looked up old cases in case law because I did go to law school looking when the Federal Reserve Bank was sued in the past. And George, they've argued two different sides. So they've argued in the past when they've been sued that they're a government entity. And then because they're a cartel, they're the most unique entity in the United States. They're government protected. They've also argued that they're a private corporation and just deserve protection from that. So they routinely jump onto either side of the line whenever they want. So, and their lawyers get away with it. And then the government judges and the federal courts let them do it too.
Yeah. And I don't want to open up a whole new can of worms, but I would suggest that your listeners or viewers, as soon as they get done listening to this interview, go right over to Google and search a Fred chart of the Fed's remittances to the Treasury. And what you will see is that has gone dramatically negative, which means if we were going off of GAAP accounting, there would be a massive hole being blown in the Fed's balance sheet that the Treasury is liable for. But you know darn well the Treasury doesn't have the money for that. So what do? They just come up with this stupid accounting trick called a deferred asset, whatever that means. And so they just fill this hole on their balance sheet with this garbage deferred asset, which is basically a piece of paper that says, oh, well, we'll just pay ourselves back in the future out of the profits that we will make, assuming that we do, when any other corporate entity that tried to pull those types of tricks would be wearing an orange suit and chiseling away at rocks.
Well, the government, the Pentagon gets away with accounting fraud all the time. Government agencies do accounting fraud. There's holes missing in budgets all the time. The Pentagon's the worst at this because there's trillions missing that are unaccounted for with Pentagon accounting. But the Fed is allowed legalized accounting fraud. The Fed, if they were doing GAAP right, they'd be writing off all their mortgage-backed security losses, their existing treasuries that they're holding while they're raising interest rates, right? Those treasuries would be down 20, 30, 40%, some of the older ones, right? With the rate hike increases, the principal value would have collapsed. They don't have to mark any of those losses to market.
Yep.
And then they have a cash flow problem, like you said, because they're paying out all these higher interest rates to reverse repo, to IOER.
Well, they don't have a cash flow problem because they can just print the bank reserves, but they technically have negative equity and they're insolvent.
Well, Joseph Wang tweeted about this. He said they're bleeding cash. So, they if they were a real business, they would be cash flow negative. But since they're a government entity, they have the money printing machine. Yeah, they can get away with it.
That's my point. So
if they were a private sector entity, they'd be writing off their bond market losses on their bonds and other securities. They'd have to mark those down, and then they'd be cash flow negative. But because they're a unique entity with the reserve currency, they can get away with all these things.
Yeah. Bottom line is if they were a private entity, they'd be FTX.
Well, they're in charge of the U.S. federal government spending Ponzi scheme. So the fiat currency and credit Ponzi scheme, and the Fed is the chief biller outer of last resort for all these central banks and hedge funds and large insurance companies. So if a Swiss insurance company that was leveraging up their trades gets in trouble and is short on dollars, they call the ECB, and the ECB says we need a swap line, and the Fed says, okay, couple keyboard clicks, boom, there's tens of billions or 100 billion, and we may never even find out about it.
Yeah. The bottom line here is I think that going into the next recession and into the future, the Fed's balance sheet is just going to backstop a higher and higher percentage of global GDP. And that's just going to decelerate or impact future GDP growth and therefore the standard of living of the society at large.
Well, they can make GDP nominally grow, right? So they can deflate the inflation rate, they make GDP grow. But in real terms, government spending is the government's taking a larger control over the economy. So government spending is already around 50%. I mean, I don't see the government cutting back anytime soon. That would be nice if it did, but I mean, the plans here are for government to spend more, gain more control.
Yeah, absolutely. And that's just the point I was making. That forget about nominal. It's all about economic output. Economic output goes down, even if nominal goes up. And that means the standard of living goes down due to the economic distortions of government spending occupying a higher and higher percentage of GDP.
Yeah, but George, like the mainstream financial media on Wall Street, they only talk about nominal numbers. So anything that spun positively for nominal GDP or GDP growth or the inflation, or they're talking about the trend right now, the CPI is headed down, the PPI is headed down. I mean, if things reverse with the Fed and the government budget deficit, we're going to see big balance sheet expansion with the Fed going forward.
Yep, totally agree.
Okay, George. Well, over an hour. I really enjoyed this discussion. Thank you again so much for your time. And I'll put links to your YouTube channel and RoboCapitalist Pro.
All right. Thanks, Jason. Appreciate having me on. It's always a pleasure.